I'm Rob Shapiro, a senior policy scholar at the Georgetown Center for Business and Public Policy, part of the McDonough School of Business at Georgetown, who are the sponsors of this forum. And we have with us the director of the center and professor at the McDonough School in the Department of Economics, John Mayo. This is a very timely topic. The challenges for the Fed, we say the economy, it's not only the U.S. economy, it's the global economy as well, in the tapering of quantitative easing. It seems like a very technical topic, but in fact it's actually fairly simple and straightforward conceptually, if not practically, and it's going to affect all of us. In fact, we're here to talk through a set of practical issues and problems facing U.S. monetary policymakers, matters which usually are confined to theoretical discussions and speculations, but today have very practical importance. It should remind us of how extraordinary this period is, and particularly how extraordinary the 2008 financial crisis was. We came through a period in which the financial wizards and the pundits had mobilized really a chorus of support from politicians as well as academics for the view that financial markets had developed in such a way as to manifest a unique combination of productive innovation and prudent self-regulation. I remember, and I'm sure many of you also remember, the assurances that Chairman Greenspan believed, that the dynamics for self-regulation protected the U.S. financial system from the kind of crisis which occurred. Lots of people believed it, and indeed, including the proposition that the economic power of that combination of innovation and self-regulation was so great that it could explain not only annual bonuses that rivaled the lifetime earnings of great industrialists, but also the fact that the sector doubled its share of national income over 20 years. That's a very unusual phenomenon, particularly for a sector which is a mature sector. And not a rising sector. The financial crisis, of course, followed and confounded these assumptions. It created conditions that had not been seen in the United States since the 1930s. We found ourselves caught in a systemic crisis that threatened the financial system here and then in most other advanced countries, and which in turn, if not addressed, would have turned into a Great Depression. Moreover, and most pertinently for today's discussion, the resolution of the immediate crisis was followed by conditions that in many respects were called a classic liquidity trap. To help jumpstart corporate and personal borrowing and shore up financial institutions, we had to create a near 0% short-term interest rate environment for the banking system. In fact, at many periods in inflation-adjusted terms, we were living with negative interest rates. And still, growth repeatedly slowed and stalled, job creation remained anemic, and incomes continued to fall. What does the Fed do then if zero interest rates aren't enough to revive demand and investment? And especially, what do you do about long-term rates? To answer that, the Fed became creative and innovative, establishing quantitative easing programs focused on longer-term securities, including mortgage-backed securities, to keep interest rates in that part of the market very attractive. We're not going to focus today on how well quantitative easing has worked, though that's a very important question in its own right, and one that is a matter of great controversy today among economists. That's because, and one of the reasons it's so important is that financial crises have become a pretty regular phenomenon in recent decades. much more regular than any period since the 19th century. Since the 1980s, mid-80s, we've seen financial crises develop across much of Latin America. Then it moved to Spain, Sweden, and Japan in the early 90s. It was followed by Mexico. That was then followed by East Asia, and then the United States. Since then, the Eurozone has teetered on the brink of a sovereign debt-based financial implosion more than once. Numerous close observers of the Chinese economy worry about serious financial problems there. Its four state-owned megabanks are technically insolvent. And yesterday, Martin Wolf in the Financial Times warned us about a potential meltdown here and in Europe based on entirely different dynamics. The misjudgments of large asset managers heavily invested in the corporate paper of emerging markets. Now that's an esoteric one for Americans. Our focus today, happily, is on matters that are a little more certain than the balance sheets of asset managers with respect to emerging markets. We know that the Fed is preparing to gradually withdraw from quantitative easing, that is, to taper it, as they say. Have global markets, or even just our own markets, become addicted to the regular infusions of liquidity from America's central bank? Recently, we saw signs almost of panic in the markets and financial circles of a number of developing countries when the Fed first said it was thinking about how and when to taper QE3. The value of the dollar went up, so countries whose currencies are tied to the dollar saw their currencies rising as well. That's unwelcome when your country's growth depends on its exports, since your stronger currency, in effect, raises the price of your exports in foreign markets. From Delhi to Kuala Lumpur, Brasilia to Lagos, the markets got very skittish at the suggestion that the Fed was preparing to taper its large purchases. How do we manage this, and what should we expect when the Fed actually does begin to taper? Does the Fed take steps to assure markets that regardless it will keep credit cheap and prevent the dollar from appreciating substantially? Does it set an inflation target? Does it cut its payments on the bank reserves kept at the Fed in hopes the owners will invest more aggressively? How does the Fed decide what path to take? What will be the effects, first on financial institutions and then more broadly on the overall economy, on labor markets, and on foreign economies? Those are some of the questions that today's topic raises, and we have a very special set of speakers to help us answer those questions. We will lead off with Alice Rivlin, who is almost uniquely qualified to lead this panel. Today, she is a senior fellow at Brookings and a visiting professor at Georgetown, but she served as vice chair of the Federal Reserve Board, giving her unique insights into the questions we'll examine today, and she was, by the way, the first woman to do so. She also served as deputy director and then director of the Office of Management and Budget, again, the first woman to do so. She was the first director of the Congressional Budget Office. You have a lot of firsts, Alice, let me say. She also was Assistant Secretary of Health, Education, and Welfare, and much more recently, co-chair with Pete Domenici of the Bipartisan Policy Center's Task Force on Deficit Reduction. In her academic life, she was the president of the American Economics Association, first woman again, and has taught at Harvard, where she received her PhD, the New School at George Mason, as well as Georgetown. Her friends, among whom I count myself, also know her as a mountain climber and an adventurer, very rare in such a talented economist. When she's done, I will introduce our other distinguished panelists, Joe Gagnon and Harry Holzer. But first, here's Alice Rivlin.
Thank you, Rob. Great to see a room full of Hoyas. When Rob called me, and those of you who know Rob know that he can talk you into anything. When Rob called, he said, we're doing this thing on QE3 and the tapering, and we'd like you to speak out of your Fed experience. Well, that would have been a very short speech, because when I was at the Fed in the late 90s, we weren't doing any of this. The economy was doing well. Some of you remember that far back. The unemployment rate was low, dipped below 4% briefly, a very good thing. And more surprisingly to conventional economists, inflation was not a problem. In fact, it was falling through much of the late 90s. Let's go back there. Unfortunately, we're not there at the moment. Let me just sort of set the scene a little bit, and then I hope we can have a lively discussion about the tapering question. The financial crash that Rob has referred to seems to me totally unnecessary. We need not have had it. It has many culprits, including the Federal, but not exclusively, the Federal Reserve. The main precipitating cause was a dramatic decline in lending standards that should have been avoided by regulators, the Fed among others. And it was characterized by a pyramiding of derivatives of exotic assets, very much over-leveraged in the financial markets, that eventually crashed down like a house of cards and brought us a really dramatic financial crash. And the deepest recession since the Great Recession. That the recovery has been slow strikes me as not at all surprising. What we know about recessions that follow financial crashes is that they're worse than others and harder to get out of. And the asset that crashed in this case was housing values, which affect everybody. It's not like having the stock market crash or the art market crash. Housing is such an integral part of our economy. Once the crash happened, and it shouldn't have, the authorities, both fiscal and monetary, just did everything they possibly could. They threw everything at it. It was a desperate moment of how do we keep the total meltdown in the financial sector from happening, and how do we prevent another Great Recession. So we had the Fed drastically lowering the short-term interest rate to zero, propping up with aggressive lending all kinds of financial institutions, not just commercial banks, and successfully, in the end, keeping, after Lehman went down, any other major institution from biting the dust. And the fiscal authorities, at the same time, engaging in quite aggressive stimulus. With hindsight, I think not aggressive enough. We could have used more stimulus, but it was big by anybody's standards. And I think this activity of the financial, of the authorities, both monetary and fiscal, worked. We didn't have the Great Depression. We turned this rapid downturn around fairly quickly, but the recovery has been long and slow, which, as I said, I think is not very surprising. And the Fed, having gotten its interest rates down to zero, basically said, what else can we do? Well, keep on buying bonds and putting downward pressure on interest rates. QE 1, 2, and 3 are not sort of exotic things. They are just saying the best the monetary authorities can do in the face of a slow recovery is to facilitate investment and borrowing by keeping interest rates low, and it's not enough to keep the short rates low, which they'd already done. They had to put some downward pressure on interest rates, and they did this several times, and the latest, known as QE3, is a promise to buy $85 billion worth of medium-term treasuries and agency debt or asset-backed securities, mostly backed by mortgages. And the jury's still out on how effective this has been. I think you can only say we would likely have had an even slower recovery if they hadn't been doing this. Meanwhile, the fiscal stimulus ran out, and the fiscal authorities have, in my opinion, not been doing their job. Many of you work on the Hill. We should have had probably another stimulus package, but certainly not the aggressive austerity that we have seen in the last couple of years, bringing the deficits down faster than they should have been if we were wanting to encourage recovery. But at the same time, we should have engaged in the other piece of the grand bargain that some of us worked very hard on, with more stimulus in the near term and a lot less in the longer term to keep our debt from growing. Effectively, with quite a lot of fiscal drag, as the economists say, negative influence from the federal government and state governments, the Federal Reserve was the only game in town from a policy point of view, keeping the recovery from faltering. I think, so the question now is the economy strong enough for the Fed to taper off or reduce the volume of assets that it's been acquiring, which is just the flip side of what it's been doing. It's been putting downward pressure on the interest rates. If it stops doing that or does it less, interest rates are likely to rise. Why do it? Well, partly because there are downsides of keeping interest rates too low for too long. It's a discouragement to saving. It invites people to reach for higher yield and maybe take more risks than they should. Certainly invites a lot of trading of securities. So we'd like to get out of this thing. Now, I haven't mentioned a risk of inflation because I simply don't think there is any for the foreseeable future. We're in an economy that not only has a lot of slack in it in the labor market and in other markets, but is extremely competitive and is in a competitive world where American companies just don't have a whole lot of pricing power. So I'm not, unlike a few members of the Federal Open Market Committee, I'm not worried that we're taking a risk of inflation. But I think we're taking a risk of having this thing go on too long. So what do? Well, you do less of it. I would think that fairly soon, probably not right this time at the moment, but maybe at the meeting after next, they decide let's do a little less buying. I'd go very slowly. Let the markets react and get used to the idea that the Fed's going to be buying fewer assets. Maybe even only go down from 85 to 80 or 75 or something like that, gradually till you stop active purchases. But then you got this big portfolio you've already acquired, and if the economy is strong enough, well, you just kind of let it roll off. You don't have to go out aggressively selling these bonds, because we probably don't want to put that much upward pressure on interest rates. But these securities mature, and you let them do that. So that's where I see it at the moment.
Thank you. Our next speaker is Joseph Gagnon, who is currently a senior fellow at Peterson Institute of International Economics. He also has spent many years at the Fed, first as a senior economist, then as associate director of the Division of Monetary Affairs, and finally as associate director of the Division of International Finance. I may have gotten those reversed. I just realized, I thought I did. First International Finance, then Monetary Affairs. He also served 2 stints at the Treasury Department, and before that he was a West Coaster, teaching at the Haas School of Business at Berkeley after receiving his doctorate from Stanford. We will overlook the fact that you're the only one of the panel who did get his doctorate from Harvard, Joe. On topic today, he is also the author of 2 insightful and pertinent books, Flexible Exchange Rates for a Stable World Economy and the Global Outlook for Government Debt over the next 25 years, as well as articles in professional journals, much more numerous than I can recount. I give you Joe Gagnon.
Thanks, Rob, and it's a pleasure to be here, and hope that you'll treat me as an honorary Georgetownian for this afternoon. So let me just start with just where Alice left off. I think she described very well how the Federal Reserve got into this position. And by the way, that's right, Rob. The last thing I did at the Federal Reserve was work in monetary affairs, where I worked on what you would probably now call QE1. And then when I left and went to the Peterson Institute, I wrote a paper on what the financial market effects of QE1 were, which is I think held up pretty well. There's a lot of people working on that now. But if I could just make one little pitch on this is one of the things that I noticed in doing this is that compared to other, I used to work in international and then I worked in monetary affairs, and one thing that was striking to me is that compared to other central banks around the world, the Fed is the most limited in its powers of all the ones I know. Now, there may be some out there that I don't know about, but the Bank of Japan can buy anything. And as far as I can tell, the European Central Bank can buy anything. And the Bank of England, I believe. So why is the Fed limited? The Fed is limited, only allowed to buy treasuries and federal agency-backed securities, and that's it. I can lend to banks on collateral, but anything else is quite limited to loans. There's emergency procedures where you can lend to other non-banks, but that requires emergency circumstances. So I would say that it would have been better, I think, going into this if the Fed had more ability to buy more financial instruments, a broader array that could have hit more sectors of the economy. What we were left was a tool that mainly affected the housing market, and that's, I would have liked to have had tools that would have affected the economy more broadly. So just put that out there. I don't see why the Fed is so, I think that's a mistake that we limit our Fed so much in what it can do. I agree with Alice that I think there's a meeting next week, a monetary policy meeting, and I don't see much chance of tapering. There seems to be a lot of talk in the market of that, and we have had good news lately, but the Fed has jumped the gun so many times now that I think they really should probably try erring on the other side. And so I totally welcome the idea of even when they do start tapering early next year, to do it slowly at first and build up. But I actually am getting optimistic about the economy next year finally. You know, I think that given the massive austerity we just had this year, which is really quite striking to me, the fact that we're still growing says the underlying economy is really quite strong, and I think that's going to show through, and I think it is starting to show through. And I think that even though I urge the Fed to not rush to tapering, I think that over the course of the year, as that strength really shows through, they will want to taper faster and faster, and rightly so. But let's just wait and make sure that the data are in hand before we do that. Let's not go too fast. Okay, so if I could just make a few more forward-looking points. Well, excuse me. Let me back up a little bit. I want to make sort of forward-looking points, but I think to be forward-looking, I want to talk a little bit about what I think happened this year. I think everyone's aware that the taper talk that the Fed gave in May and June of this year really had a strong effect on financial markets. We saw a big rise in bond yields. And I'd like to just give you a little bit of my understanding of how what that was, why that happened, and how that affects. I was asked to talk about other countries, and so I want to talk a little bit about the effects of QE on emerging markets. My reading of the situation now is that there may have been a bubble in the bond market earlier this year. If I think about what interest rates should be given expectations of the future path of Fed policy and the level of quantitative easing, I couldn't explain how low bond rates were last spring. I think the Fed's taper talk actually kind of burst that bubble in my sense. And we are now seeing long-term bond yields that make more sense to me, that seem about right given the state of the economy and the amount of quantitative easing. And so that gives me a little hope that going forward, if they do start tapering, you won't get the same massive rise in bond yields and panic that you had last summer. And that says that to attribute the whole rise in bond yields to tapering is not quite right, because it probably was just a market reassessing where they should have been rather than actually the Fed policy. Because if you look at where Fed policy is now relative to where people thought it was 6 months or a year ago, it isn't tighter. I mean, if anything, there's going to end up being more QE when it's all said and done than anyone expected, most people expected 6 months or a year ago. So it's hard to justify what happened on a pure rational basis. And I think there was just a bit of exuberant pricing, shall we say. And I think that's out of the market now, so that's the good news. Let me talk a little bit about emerging markets. In particular, a lot of people noticed that there's a lot of investors got afraid of emerging markets after the tapering talk. Again, I think one doesn't want to link that too tightly with what the Fed is doing. I think it was more of a wake-up call to investors to rethink what they were doing rather than a mechanical connection between capital flows to emerging markets and what the Fed is doing, because if you look across the markets, the response is very different across markets. And if it was just purely the effect of QE on capital flows, you would expect it to hit every country roughly equally. It didn't. What happened, if you look at sort of India and Turkey were hit, but Mexico and China were not. So what goes on? Well, if you look at the fundamentals in those countries, they're very different. And it was sort of a wake-up call to investors to think about the fundamentals of the countries. It was spurred by taper talk, but it wasn't really linked to tapering. It was more linked to the fundamentals of the countries. And so I think we need to keep that in mind going forward. The other thing is that the flows to emerging markets during this QE3 have not been particularly large in historical circumstances. I mean, they're not unusually large. They're similar to what we've seen in other episodes of relatively low interest rate periods. And so one shouldn't think of quantitative easing as being an unusual policy that has unusual effects that we've never seen before. That's not really true. I mean, to the extent that it encourages capital flows out of America, it's not any more than we saw in the 90s or before the crisis. So one shouldn't get carried away about how QE is something different in that respect. So finally, let me just talk a little bit about what to think about going forward, I think, as I said, bond yields now, to me, look about right, given the state of the economy and given what the Fed has said and given what the Fed's done. And so I see less reason to expect turbulence. But on the other hand, the fact that we're in uncharted territory, the Fed's balance sheet is going to be $4.5 trillion probably when it peaks. It's 25% of GDP or 26% of GDP almost, which has never happened before, ever. We're in uncharted territory. And I think there's a tendency in the markets and frankly at the Fed to want to get back to normal too fast. And so I think the sort of story for the next 2 or 3 years is going to be the market trying to anticipate the Fed's move too fast, and the Fed having to slap the market back down. Moreover, the Fed itself has continually been too eager to get back to normal, and it's been slapped down by the data. And this is a recipe for turbulence going forward, I think. So although I think rates are at reasonable levels now and I see less reason for a large jump, I see lots of reasons for turbulence going forward as rates gradually renormalize from here, as the market tries to get ahead and then get slapped down. So I see a repeated movement like that. And I'll end with a theme that's got out there a lot lately, I think is called secular stagnation. I actually have a lot of sympathy for it. I think there's a number of factors, and I'll be happy to talk about it later, but I want to end on this point, that are pushing the U.S. to have lower interest rates permanently than people think. I think a lot of people think that the normal federal funds rate is 4%. I think we're going to see in the future from now on that's going to be viewed as a somewhat tight, high rate. I think 3 might be more normal going forward. And I think the Fed itself is just learning about that gradually, and it's going to find that when it raises the rates to 4 or higher, the economy slows much more than it expects, and it's going to be pushed back by the data too. And I think we're going to move to a world of lower interest rates. We basically, the factors behind that are things like slowing population growth, aging of populations, rising saving rates, combined with factors overseas, which includes a lot of emerging markets saving rather than investing, and their governments are sending money to the U.S. to invest here, which keeps interest rates down here. And those things are likely to continue for several more years, or if not longer. Altogether, to me, they mean that the equilibrium real rates, interest rates, are probably lower than people think.
Thank you, Joe. Our third panelist that we'll hear from is Harry Holzer, Professor of Public Policy at Georgetown and an Institute Fellow at the American Institutes for Research. He also has a distinguished record of public service, including Chief Economist of the Department of Labor during the Clinton administration. In his academic life, after earning his doctorate from Harvard, he was Professor of Economics at Michigan State, an Institute Fellow at the Urban Institute, and co-founder and co-director of the Georgetown Center on Poverty, Inequality, and Public Policy. He is the author or editor of 11 books, and he is one of this nation's leading labor economists. And today I hope he'll share with us his insights on the impact of tapering on the labor markets. Harry.
Thank you, Rob. So I want to start by saying I know a lot less about monetary policy certainly than anyone else at this table, and probably less than many other folks in the room. So I'm going to move pretty quickly to talk about the jobs market and what all this means. And of course, in order to figure out what the taper means for jobs and employment, you have to have some sense of what QE 1, 2, and 3 meant for jobs. So I talked to 1 or 2 people I know at the Fed that do modeling, and they gave me some numbers, and then in a little sidebar with Joe that we had before we started, he told me my numbers were much too low relative to what he knows and relative to what Janet Yellen claimed in a speech she gave, reminded me that she had given the speech a year ago. Janet was my college macro teacher, and I think she's wonderful, so I would virtually never contradict her in public. But my sense is that the numbers are a little lower than what she claimed in that speech. So when I was doing so for instance, when I talked to my friends at the Fed, they told me, well, you know, the sum effect of QE1, 2, and 3 was to bring down long-term rates by about 0.5 percentage point, 50 basis points. And again, Joe has said most people think that's too low, but maybe they meant after the reaction of the markets to the talk of tapering, so maybe that moderated the effect. Regardless, I did some back-of-the-envelope calculations, and I came up with a total effect on unemployment of about 300,000 to 400,000 jobs. And again, Joe, when I talked to Joe, he thought that was too low, and he thought maybe it's more like double that, 600,000 to 800,000. But let me tell you a couple reasons why I think the lower numbers still make more sense to me. And I'll just throw out two facts. First of all, you would expect lower long-term interest rates to have their biggest effects on employment in construction and manufacturing, which are the two most interest-sensitive sectors. Well, if you look at employment growth there, it hasn't been that great. We lost about 4.3 million jobs in those two sectors in the recession. That's a big number. And we've gotten back about 800,000 of them, or only about 20% of what we originally lost. About 500,000 in manufacturing, about 300,000 in construction. And the manufacturing jobs came back much earlier, and they've kind of leveled off the last couple of years. So when I look at that pattern of job creation, it's a little hard for me to believe that QE3, whatever the impact was on long-term rates, really had a really large effect. And of course, there would be second-round spillover effects on the rest of the economy from those. But it still strikes me as not being a huge number. And secondly, when you look at the unemployment rate, so the good news is that the unemployment rate has dropped from 10% to 7%. The bad news is that almost all of that is because of people dropping out of the labor force and not being mentioned. I think that at least 80% of the drop in unemployment is because of people dropping out of the labor force, and that actual job creation only accounts for a little bit, maybe 0.5 percentage point of that drop. So if the total job creation effect has been 0.5 percentage point, again, it's hard for me to see that all of it was created by QE 1, 2, and 3. Again, my better guess is 2 or 3/10 of a percentage point of unemployment, a much smaller effect. Now, that's not trivial. Whether it's 300,000 jobs or 400 or 6,000, it's not trivial. These things accumulate, and that's a number we should be glad to have compared to the performance of the rest of the job market. On the other hand, on a flow basis, on a monthly basis, it's pretty low. 10,000 jobs a month, 15,000 a month, something like that. And it's really swamped by other changes in the monthly flow of jobs that are hard to predict, and we don't really know what they're going to look like. So again, let me throw out a few more numbers. And I apologize for throwing out these numbers, but I think it does shed some light. For a long time, we were stuck at 150,000 jobs a month, 100 of which you needed to sort of keep up with what we thought was normal labor force participation. And about a year ago, it kicked up to 200,000 a month. And in some sense, we were lucky that it kicked up at that time, because GDP growth was actually pretty lousy in that period when it kicked up. I think we got lucky that we had low productivity growth. By the way, economists don't usually talk about low productivity growth as being such a good thing, right? We want high productivity growth over the long term. But when the job market is this tepid, I don't mind productivity growth being down a little bit for a year or two just to try to get some of those people working again. So we got lucky with that. And then, of course, GDP growth the last 6 months has bumped up. Right now it's averaged 3% or so over the last 6 months. And it makes more sense now that you're at 200,000 jobs a month. If we stay at this pace, and let's say our target is we're trying to get back to 5% unemployment, which is roughly what a lot of people think the NAIRU, or the natural rate would be. At 200,000 jobs a month, it will take us 3 more years to get back to 5% unemployment. We'll get there at about the end of 2016. And that will have meant 9 years of depressed markets until we got back to it. So that's a long, slow recovery. If we get lucky, and let's say that 200 kicks up to 250 a month. And by the way, 250 a month would be spectacular by the standards of this recession. Compared to most earlier recoveries, it's not not that great, really. But if we got up to 250 in less than 2 years, we'd be back to that 5%. So those kinds of swings completely swamp whatever impacts I think might have come from QE3, and especially if the tapering is gradual, as everyone said they hope it is, and I certainly hope it is, it will have a much more modest effect on the job market, and these other things I think would be much more important, and you wouldn't see it in the numbers. But again, before we pop the champagne on some of these, let me just throw out a few other things that we still need to worry about, and then I'll stop. So let me start with what I said about the big drop in labor force participation. It's a 3 percentage point drop in participation. That's 7.5 million workers dropping out of the job market. Now, we anticipated some of that with the beginning of the retirement of the baby boomers, but we only anticipated maybe a third that much from those retirements. And let's say the retirements, some of the baby boomers, who are permanently laid off and aren't seeing good job, maybe they left permanently and started earlier retirement, or maybe some of them are on disability. Still leaves a chunk of 3 or 4 million people in their prime earnings years that are out of the job market, and we don't really know if and when they're ever going to come back. So that's one thing to worry about. Secondly, we do have this problem of long-term unemployment and long-term non-employment, the non-employment being the people out of the job market, the unemployment being the people still officially in. If you define long-term unemployment as anything over 6 months, we have 4 million long-term unemployed people right now. And again, if you add in some of those people who were out of the job market, it would be considerably larger, 6 or 7 million. Right now, employers indicate that they're quite reluctant to hire these workers. And sometimes for good reason. I mean, we know that people's skills depreciate, their information depreciates when you're out of the market for a long time. And on top of that, we have evidence of employer discrimination. And why shouldn't employers? I mean, right now, it's such a buyer's market in most places. Why should they not hold out for their best candidate? But that would give us another reason for concern as we go forward. Related to that, the job vacancy rate right now is 2.8%. Now, compared to 7% unemployment, that doesn't sound all that high. On the other hand, for this stage of a job market, it's higher than you would have expected. And whenever the job vacancy rate is high, at the same time you have unemployment rate being high, people start wondering if you have some kind of structural unemployment problem, and workers don't have the skills and employers looking for something like that. And economists have been arguing about this. Is it really that they can't fill those vacancies, or is it that they're not trying all that hard to fill them because they don't really want to hire these people that badly? And I've seen some evidence on both sides of that argument. But there is this question of whether, at what point, if nothing else, the long-term unemployed might end up being that structural problem that keeps us getting back to the 5% that we're looking for. Joe closed with secular stagnation. I was also planning to close with secular stagnation. I don't know if it's real or not. Larry Summers gave a sort of a speech that got a lot of press on that, and he got into a little back and forth with Ben Bernanke. And when I look at all the factors, some of which Joe listed, they strike me as being quite plausible. And even on top of those, even if GDP growth is not responsible, I worry about simply in the job market the impacts of a kind of globalization, the offshoring of not just goods production, but service production, the combination of technology and globalization leading to an offshoring that the people like Alan Blinder worried about a lot 6 or 7 years ago. And even if it's a small, we have no good numbers on this at all, but even if it's a slow process, 250,000 jobs a year, 500,000, those are permanent dislocations, and they add up over time. And that, on top of all the things that Joe correctly mentioned, could give you this sort of labor market stagnation on top of whatever happens in the demand for goods and services. I haven't even gotten to wages. We can go there. We haven't obviously had time to talk about policy. So I don't think the tapering of QE3 will have an enormous impact on the job market. I think it will be swamped by these other factors. I'm hoping at a minimum we'd stay at 200,000 jobs a month and maybe move up to 250, and time will tell. We'll see what happens. Thank you.
Thank you. Thank you, Harry. First, I'd like to invite the panelists to ask them if they have any comments to the comments they have heard from their fellow panelists, and then we'll open it to questions from the audience. We'll start down at that end. Anything, Joe?
Just one point, Harry, which is I was thinking about the Yellen speech, And if I remember it correctly, because I'm just going from my memory, but I've actually quoted it a couple times in things I've written, so I think I have it right. If you take what Janet Yellen said last spring about the effects of quantitative easing on the job market and scale it up to the amount of quantitative easing we've had, I believe it would imply more than 3 million jobs is what would be the, now that's not a permanent effect, but that's sort of a peak effect over about 2 to 3 years. And I agree with you, that's just way too big. But I would guess half of that sounds about right, which is still a lot bigger than you have, but I would just throw that out there for people. I mean, I don't know. The one thing I would say is I think what I find plausible is that the effects of QE on bond yields may be quite large, but the effects of a given move in bond yields perhaps are probably is much less on unemployment than it used to be because of all the deleveraging in the economy and the unwillingness of banks to lend and things like that that have prevented Fed policy from affecting the economy as much as you would have thought for a given amount of interest rate.
And yet, Joe, if that's correct, should we expect larger effects from tapering in the labor markets than Harry suggested?
Well, I think what one has to think is, I mean, there will be no tapering if it would hurt unemployment. I mean, the point is it's the other way around. It's strong employment is going to enable tapering, not vice versa.
Right. Alice?
I'm not going to take sides because I don't think anybody knows on exactly how much of impact the QEs have had on employment. I did want to question Harry's evidence, though, for just a minute. I don't think the fact that construction jobs have not come back very fast is real evidence one way or the other about the effect of the QEs. We built too many houses by a long shot and a lot too much commercial property. It was going to take a long time to absorb that excess no matter what. And until fairly recently and in specific markets, you'd have been nuts to borrow money to build anything. So I wouldn't take that too seriously. But I just wanted to throw on the table for possible discussion. I think we're all pretty much agreed that A, we're not out of the woods yet, and B, doing additional QE forever is probably not a good idea. So what else do we do? I think we've got to start thinking differently about fiscal policy.
Eric?
Oh, where it says push, I should have been pushing. No, I mean, as almost always, Alice is right. And I think you can distinguish between the effects to date on employment in construction, which have to be small because the bounce back has been so small, versus what that impact might be now that the housing market is starting to recover. So you can make the argument that the impact of the same interest rate reduction would be much greater in the future than the past, and I think that's legitimate. But again, I still think that the other movements in job creation still swamp the effect, and as Al said, what does it mean for fiscal policy and other policy options, I think, would be a good thing to talk about.
I also just want to offer one other comment, and that is it's because something you just said reminds me of how the Fed has really been in a almost purely reactive position throughout this period, reacting to the crises, reacting to what Congress did, reacting to what Congress didn't do. And that one of the things that Congress and the administration failed to do at the very beginning was make a greater effort to stabilize the housing market as it was stabilizing the financial market, which was a major contributor to the depth and the length of the recession, and even more to the length and slowness of the recovery. And so the Fed was certainly responding to that as well. That is, responding to the fact that for 4 years, the majority of Americans found themselves growing poorer every month as the value of their primary asset declined. I'd like to open the questioning now to the audience. You've been very good. You've sat through a hour discussion of monetary policy, which we usually don't expect of civilians. So now's your opportunity to ask any of the panelists any question you'd like. Yes.
For Ms. Rivlin, you said in your comments that you didn't foresee any kind of inflationary pressures in the future. Do you think that there's any potential side effects to the various QEs in terms of inflating other bubbles? You know, any other kind of bubbles throughout the economy that might not manifest itself in a broad general consumer inflation?
Yes, I think there is that risk, and I actually said that about having very low interest rates for a very long time invites people to look around for how do I make money in this world, and I think a lot of that has manifested itself in trading, and that may give you some a stock market upward pressure on stock market. And possibly local housing markets, and maybe other things. But I don't see how you get general inflation in a situation where we have, as Harry said, not only 7% unemployment officially measured, but a lot fewer people in the labor force than we would like to have, and very little evidence of any shortages of anything.
Can I say we saw very little inflation in the last expansion, the expansion that was creating a bubble, and with very easy monetary policy and easy fiscal policy. And that tells us, and this was mentioned before, how powerful the disinflationary force of the intensification of competition from globalization has been on the U.S. economy.
And internally.
And internally,
And,
absolutely.
you know.
Absolutely, from technology in particular. Right, yes.
Is there any evidence that the outsourcing is slowing down and jobs are returning to the country? And the second question is, we're going to have a long period of low interest rates. Does that also mean we're going to have a very long period of relatively high unemployment?
So I'll take a crack at that. If you ask for evidence on offshoring, the quick answer is no, because no one has really good data. I mean, there are some official numbers that always look very low, and the people who look closely at how those numbers are measured usually don't believe them. It's not clear that they have a better answer, a better way of doing it, but there's a lot of uncertainty with it. So a lot of what you have is a lot of anecdotes. And some people who follow this stuff closely say, you know, there was a big burst, and that maybe now we're at something more of an equilibrium, that maybe after that big burst, things will level off. But it is a cumulative effect. So even if the new flow of these jobs in outsourcing is very small on a monthly or yearly basis, they do have this sort of cumulative effect, and it could be costing the economy several million jobs at this point. Although again, I emphasize we don't know for sure. The second piece, are we entering into a period of long-term unemployment? You know, quite possibly. And again, a lot of it depends on what happens to those extra 5 million people that have dropped out of on top of the retirements that we anticipated, and how many of them, and whether or when they might come back, and of course what happens to those, this period, these long-term unemployed folks, and you know, subject to all the caveats, I said if we stayed at, you know, we could get back to 5%. And some people think 5%. People don't really know what that target should be. That's another number we kick around. The CBO has estimates of what they think this natural rate is. Other people disagree, and if we're in a period of where the bias is towards non-inflation, it's possible that that number should be lower, but it would be hard to get there, given all the slack demand that Joe and I talked about, and that I think that Alice agrees with as well.
Can I add one thing to that? I think, yes, Harry's obviously right, and it's mostly anecdotal. But there are quite a lot of anecdotes of companies that thought moving their production to China or to some other parts of Asia was a really great idea, and have discovered that it gives them all kinds of problems, including as those countries develop rising wages.
But of course, there's been a lot of talk and, again, speculation about a manufacturing renaissance and the companies that realized it wasn't so great going there. Some of that, I think it's one thing for production to come back. It's another thing for jobs to come back. And I think the companies that make the calculus that they're just as well off here as over there, often that's based on having relatively few workers anymore in those factories. And the jobs, if it's advanced manufacturing, the jobs that often come back are these high-skilled machinist, engineer kinds of jobs. That's sort of a different animal than it was before. So I do think that when you hear these anecdotes of companies moving back, but the implication of that for jobs as opposed to output, I think, is a little smaller.
And economists always talk like manufacturing is where it really matters. And we don't have very many manufacturing jobs anymore.
Yeah.
I'd like to just make a point that's a little on the second part, which is the interest rate connection, because yeah, I think that the high unemployment is what's the signal to the Fed to keep interest rates low. And so as long as that's the channel that the Fed thinks about, is that they're being forced to keep interest rates low because unemployment remains high, and as unemployment goes down, they'll gradually let rates go back up. But I don't think that there is a long-run connection. I mean, I guess as a macroeconomist, I think that the point about interest rates is that they need to be wherever they need to be to keep us at full employment. And I think going forward, that level that will keep us at full employment is going to be lower than it used to be. But it need not mean that, it doesn't mean that we can't get back to full employment. It just means that when we get back there, we'll have lower rates.
And just one final small point, and this is something that Harry mentioned earlier, but I want to emphasize it, that if you look through all the best employment reports we've had in the last year, the number of long-term employed hardly budges at all. They're just not going back to work. Yes?
Hi, please excuse my ignorance if it's a foolhardy question. This is my first year in the evening program for the MBA. As a trader, as someone who plays around financial markets, I have a question, and it concerns the end of QE. Let's say, the spike in bond yields from 1.7% on the 10-year last April to roughly 2.8 today. Financial markets kind of front-running the Fed, you get kind of a larger effect. Now, if we assume that maybe the taper is not priced into markets now, and we get a large correction in financial markets, which from the Fed talks about the wealth effect. If you get a large correction in markets and you get kind of a deflationary effect and the taper is complete, do you see the Fed coming back in? Could we see a QE infinity 2? If not, what do you think would be the Fed's tool of choice if it wasn't QE to avoid deflation?
Anybody?
Well, as I said, I wish they had other tools, but I think that they're trying to talk about guidance about future rates, and I think that's what their first policy would be. If markets were to push yields up higher from where they are, and the Fed thought, no, this is bad because it's going to derail the recovery, the Fed would say, push back first by saying, no, you guys are wrong. We're going to keep rates lower for longer than you think, and they'll try to do whatever they can to make that message, get that message out there. They'll try to talk about thresholds or change thresholds or guidance. But I'm in the camp that thinks that they push that tool about as far as they can push it. Ultimately, actions speak louder than words, and purchases matter. And if they will go back if they have to, if the alternative is inflation falling and unemployment, staying high. But they don't anticipate that. But I'm just saying.
I do. I just wish we could get the fiscal authorities mobilized so this wasn't all on the Fed, because they haven't got very good tools.
One more question. Yes.
Thank you for the fantastic presentations. And remember just mentioned that Fed has made this power on lines of priorities and product security. And as you talk about, so maybe it's time to look at the fiscal policy to say what changes can be made. Is there any changes you would like to say that be made in the recent future? And how will fiscal policy? Yeah.
Yes. Although I think that the bargain which seems to have been struck between Paul Ryan and Patty Murray is a lot better than nothing, and I'm really pleased that they did it, and shutting down the government again would be truly insane, and this avoids that. But I don't think that the fiscal policy that we're left with is really appropriate for a situation in which we have a slow growth economy and the prospect of future growth in debt faster than we expect the economy to grow. So I'm a grand bargain aficionado. I think that some version of what was proposed by the two commissions that I served on, Simpson Bowles and Domenici Rivlin, still right. Some more investment in the economy in the near term. Surely a great nation can do a little better with its infrastructure than we've been doing, and skills are extremely important. But then we have to tackle the hard stuff, which is slow the growth of the entitlement programs. It's not as hard as it used to be, because the growth of healthcare spending is already slowed, and that's good news. Put Social Security back on a firm foundation, and have a tax reform that gives us a more pro-growth tax system and more revenues in the future. It's conceptually, I think, pretty easy to describe. It's the politics that can't do it.
So I certainly agree with that. The only point I would add, and I share Alice's vision of the grand bargain, where you'd be stimulating more in the short run and really reining in the entitlements, and especially Medicare in the long run. But interestingly, you purely from a job market perspective, you don't need broad-based stimulus. Some fairly well-targeted things like infrastructure, like spending some money on earn and learn strategies for young people, apprenticeships, things like that. Wage insurance for the older workers. So there's some well-targeted things that really wouldn't cost all that much money that would really make some difference in such a lousy job market. And the fact that none of those have been on the table, I think is very unfortunate. The other thing I'll mention, that President Obama recommended a sort of increase in the minimum wage. I wasn't sure that now was the right time, but given the gridlock in Washington, the states and localities are rushing ahead to do that at much higher levels than I felt were comfortable. So I had an op-ed a couple days ago in the Washington Post sort of saying that, some moderate or modest increases I could support, but not what I'm seeing yet. And what few friends I still had from my Clinton administration days are mostly gone. But that's another thing that happens when the federal government is completely paralyzed, and other folks fill that gap, and they don't always do it that wisely.
Can I make a non-fiscal point, or
Sure,
which
absolutely.
No one's mentioned the trade deficit, and I don't want to go into it too much, but in U.S. history in the past, we've had trade deficits many times, but prior to 2000, the year 2000, whenever we went into a recession, our trade deficit went into balance or even surplus, every time, until the year 2000. Since then, we've had two recessions where we continued to run a trade deficit despite being in recession. That never happened before in U.S. history. And it got worse this time than in 2001. And So something different is going on in the world that this would help. I mean, part of the normal adjustment to countries going in recession and booms and busts is to have the trade balance move in the opposite direction to help cushion the blow. And that mechanism has been partially disabled. And I think, without going, I don't want to get too much further, but to me, one big difference that I see that coincides with this development almost perfectly is that a lot of governments in emerging markets have decided that they're going to spend a lot of money to maintain trade surpluses regardless, and this short circuits the natural equilibration in the world.
I never thought I'd have a chance to be on the higher minimum wage side of an argument with Harry Holzer, so let me take my chance here. It has seemed to me that the total absence of the federal government since 1993, was it, when we last did a minimum wage, has left us...
1998, I think.
No, 2007 to 2009.
Really?
Yeah, a federal increase. Yeah.
Oh.
There was a federal increase? Well, okay. It's been a long time. And but the opportunity, it seems to me, is exactly that states and localities are beginning to jump into this breach. And obviously they could overdo it, but maybe that's not so terrible, because the problem with the minimum wage has always been that a single rate was never appropriate everywhere, and you always had arguments about job loss in places where there were a lot of people close to the minimum. But there are a lot of places where there aren't. And it might actually be a nice experiment to have some substantial raises in the minimum wage in some urban areas where it's plausible, and see if that doesn't increase demand.
And I'm not usually on the side of arguing against these things. And it is kind of fun. Although interesting, the Huffington Post had a piece yesterday that said, Bill Clinton's labor economist opposes minimum wage increases. And I guess if you ask Bill Clinton, he'd say, Harry who? But you know, my concern is, so for instance, the District of Columbia and Montgomery County and Prince George's County have voted to go up to $11.50.
That seems high.
That's really high. That's a 50 to 60% increase after inflation, on top of the increases from 07, 09. And I understand the argument that in some sense more localized increases may make sense because of the variation in conditions, but I'm also worried if it gets too localized, it's pretty easy for businesses to sort of shift across a municipal border. You know, like in Montgomery County, I know people at the high end of the county are worried about a lot of job growth shifting to Frederick County, which at least right now is going to have a much lower, you know, and again, and all the estimates among labor economists have been that these effects are usually pretty small, but most of that research is not based on increases this big, so I don't think that increase, and again, in a world where the job market is already so soft, and the people with very high unemployment rates, often, you know, young people, very unskilled workers, are the ones most at risk. I would just prefer a better balance. Like I sort of said, I'm comfortable with going to $8, $9 an hour over the next couple of years, not 10, 11, 12, or even $15 that you saw in SeaTac a few weeks ago.
But you can't move an airport.
That's true. But there's some jobs in the locality around that. Not everybody works at the airport. So.
But it's a great opportunity for research for labor economists.
Well, that's
don't knock it.
Thing, so.
With Alice, I'm known for not being a fan of increasing the minimum wage, and a great advocate for applying earned income tax credits instead, and got President, then Governor Clinton, to shift to that position at the beginning of his administration. But the fact is, we do have to note that underlying conditions have changed in ways that are very important for thinking about the impact of the minimum wage. The population of people on the minimum wage has changed. It used to be, if you look back 20, 25 years ago, it was literally distributed across the income distribution because there were so many teenagers and second earners from middle class and even upper middle class families taking part-time minimum wage jobs. We're returning much more to a period in which heads of households are dominating the minimum wage labor force. And the other, even more important change, it seems to me, is that, you know, when we were debating it in the early 90s and in the late 90s, everybody else's wages were rising at a very healthy rate. It was just the people at the very bottom who were stuck. Now we have no one rising. So the debate becomes quite different, I think. I want to thank not only our distinguished and fascinating panelists, but also Andrew Salvatore, who put together this event, and my co-chair in planning it, Carol Corrado over there, and again, John Mayo and the Georgetown School of Business and the Center for the Study of Business and Politics. Thank you very much.